Welcome to our Blended Finance in Latin America and the Caribbean webinar. Um, uh, some quick housekeeping rules. So we encourage you all to rename yourself to display your full name and location or organization. You could all stay on mute and just unmute yourself when it's your time to present or when you'd like to ask a question when we reach the Q&A. You can feel free to use the chat box. It'll be enabled and live the entire time. Let's get started. So I'd like to hand over and introduce my colleague Heiner Skalix, who's our Senior Advisor for Latin America and the Caribbean here at Convergence. Heiner, over to you.
Thank you, Snea. Good morning, good afternoon, buenos dias to everyone. Great to be here today to be able to talk about blended finance and blended finance in the context of Latin America and the Caribbean. This is our first webinar that we have focused on the region, so we're excited to share data with our participants today, as well as very valuable insight from our panelists. Great team of panelists that we have. I'll be introducing them after the session on the data presentation that we have, and we'll be able to listen from them directly as to how they view blended finance in the region, what the opportunities are, what the activities are. So without further ado, let me pass it on to my colleague, Edra Pampa, Manager of Content at Convergence, to provide us an overview on the data in Latin America and the Caribbean. Andrew?
Thanks very much, Heiner. If we go to the next slide, Convergence's historical deals database tracks blended finance transactions occurring in emerging markets. To be included in our HDD, a transaction must include a below-market concessional investment, according to one of our four archetypes, at least one private sector investor, and must also target the SDGs in emerging markets. Convergence's database has recorded over 1,000 blended finance transactions with an aggregate deal volume of around $200 billion. The Convergence database has also recorded 171 blended transactions targeting South America, Central America, and the Caribbean in part or in full, representing aggregate committed financing of $25.5 billion. LATAM represents around 17% of the deals in our database and 13% of the deal volume. Latin America has historically enjoyed higher volumes of local and cross-border private investment compared to other developing markets due to its relative proximity to the US and its collection of middle-income countries close to or above investment grade. However, political and administration transitions and the policy and regulatory upheavals that result have historically fed into investor uncertainty across many LATAM countries. And more recently, LATAM was one of the regions most affected socioeconomically by the COVID-19 pandemic, with FDI flows falling by around 45% in 2020. If we go to the next slide, we can delve into some more of the trends that we see in our database. So to start, funds account for around 40% of all LATAM transactions compared to 30% of the overall market, while companies and bonds are less prominent in LATAM. With funds offering investors simplified and familiar structures that ultimately aid scaling, fund simplification is key to successfully catalyzing private capital. That is, having clear instruments according to investment theme, such as senior or subordinate notes with clear features like tenors and interest rates, is helpful. Offering clean debt instruments, for example, that can be easily digested can help increase investors' interests. In the report that we published on LATAM last year, we also explored how green, social, and sustainability-linked bonds may also become more prominent in LATAM over time. So one example here includes the $364 million Blue Bond for Ocean Conservation, which closed in 2021 and funds debt sustainability and marine conservation in Belize. It was backed by funding from US DFC, as well as political risk insurance and a Convergence proof of concept grant. Concessional debt and equity has appeared in LATAM-focused transactions at a much higher rate than the overall market, as has technical assistance. Meanwhile, alongside design stage grants, guarantees have appeared in LATAM-focused transactions less frequently than in the overall market. The fund and project guarantees constituting the bulk of the LATAM-focused guarantees in our database are most often joined by another archetype like concessional debt equity or technical assistance within the transaction. So examples here include the Telecom Energy Efficient Street lighting project, which looks to upgrade public street lighting in Chile with high efficiency LED technology. So this project was funded by loans from the Inter-American Development Bank Group, the Canadian Climate Fund for the Private Sector in the Americas, and the Clean Technology Fund, alongside technical assistance and a first loss guarantee from CTF's Energy Efficiency and Self-Support Renewable Energy Program in Chile. If we go to the next slide, we can begin to break down some of the key sectors in LATAM. So first of all, renewable energy has been a key sector for blended finance in LATAM. Around a quarter of LATAM's energy is sourced from renewables, mainly hydropower and biofuels, which is twice the global average. Also, 10 countries in the LATAM region have pledged to generate 70% of their total energy consumption from renewables by 2030 as part of the Renewable Energy for LATAM initiative. Some examples here include Uruguay's La Jacinta solar PV project, amongst others. IDB Invest, the private sector arm of the Inter-American Development Bank, oversaw the construction phase financing and refinancing and deployed concessional funds from the Canadian Climate Fund for the Private Sector in the Americas to mitigate construction risk, attract institutional investors, and develop the commercial track record for the solar energy market in Uruguay. I encourage all of you to check out the case study that we actually published on this transaction, which I can share in the chat after the presentation. If we go to the next slide, we can begin to see some of the key countries and also some of the key, I guess, the investment sizes, the typical investment sizes that we see in each respective country. So just to start, overall, LATAM transactions have a median size of around $49.3 million compared to $54.8 million for all blended transactions, with 51% below $50 million and only 29% above $100 million. Like other regions and segments within the developing world, the paucity of bankable deals in LATAM relative to investor interest was a common theme raised by key stakeholders that we interviewed in our report. Unsurprisingly, transactions that have still been successful in catalyzing private investment at scale in LATAM have predominantly been focused on energy infrastructure. So for example, Brazil's LD Cellulose, one of the world's largest dissolving water plants, was backed by $1.1 billion in debt financing co-led by IFC and IDB Invest, in which 7 commercial banks participated. And as we can see, we think here that transactions in Brazil show promise for scaled investment. If we go to the next slide, we can begin to see some of the key end beneficiaries in LATAM focused transactions. So rural and smallholder farmers and women are more supported as end beneficiaries in LATAM compared to the overall market. So examples that we explored here in the report on LATAM that we published include AgriPac, which is a leading agribusiness in Ecuador. In 2021, IDB Invest provided AgriPac with a senior loan of up to $16 million. And through the Women Entrepreneurs Financing Initiative program, it will grant AgriPac a $400,000 performance-based payment based on it increasing the proportion of women-owned SMEs in its supply chain, a goal for which IDB Invest will also provide AgriPac with technical advisory services. If we go to the next slide. Here we can begin to break down some of the typical investors that we see in blended finance transactions targeting LATAM. So just to start, every blended transaction mobilizes capital from at least one private sector investor. Most commercial commitments to LATAM-focused transactions have come from DFIs and MDBs and commercial investors, predominantly commercial banks, diversified financial institutions, and large corporations. Development agencies, DFIs, and foundations, meanwhile, have been the main concessional actors in LATAM. And if we go on to the next slide, we can actually begin to see some of the key profiles and some of the key investors that we have tracked in our data set. So again, for example, on the DFI and MDB side, investors like IDB Invest and FMO and IFC have been particularly prominent, whilst amongst development agencies, C2F, CTF, USAID, etc., have been particularly prominent. And we can also see the volume of transactions coming from the DFI and MDB side, which is far above any other key investment type that we see in the LATAM region. So I think I'll leave it there, and perhaps we can go to the next slide.
Wonderful. Thank you. Thank you, Andrew. As we reflect on this data, feel free, folks, to drop any questions you have in the chat. Andrew will be able to stay online and support with any queries you may have regarding the data and the data brief that we wrote. And we'd also love to hear from our panel, which is coming up next. So I'm delighted to invite my colleague Heiner Skalix, as well as our panelists, to switch on their cameras and come on screen. Diego Penagos, the Senior Investment Specialist from ProColombia, will be joining us. ProColombia is the official Colombian government agency in charge of promoting foreign direct investment into the country. Ariana Pevide, who is the Blended and Climate Finance Director from MUFG Bank, is also joining us today. Mitsubishi UFJ Financial Group is one of the world's leading financial groups. And Carolina Lobo Guerrero, the CFO of Vivala, is also our third and last panelist. Vivala is a growth capital financial agent working to bridge the financing gap for women-led, LGBTQ+-led, and positive impact SMEs in the missing middle in this region. So thank you all for joining us. I'm going to quickly drop everyone's bios in the chat for folks in the audience to also read through on their time. And Heiner, over to you.
Thank you, Snea. And thank you, Andrew, for providing the overview on Latin America and the Caribbean with those statistics, with the data, with the trends as to what we're seeing in the blended finance space. A big thank you to our three panelists today. It's great to spend the next 45 minutes or so speaking about the activities that you have in the region. We're joined by approximately, or closing in on 70 participants, which is great. And once again, thank you everyone for being here this morning, this afternoon, on this webinar. Snea provided the introductions on who our panelists are today. So let me just jump straight into a general question that I have, or a question that is applicable to all three of our panelists. And perhaps we can start with you, Diego. And it's, can you reflect a little bit about the data the data and the trends that Andrew mentioned in as far as blended finance and what we're seeing in the region? Can you share a little bit of your own perspectives on blended finance and the activity that you've been seeing from ProColombia?
Thank you, Heiner, and thank you for the invitation. It's a pleasure for me to be here and share with all of you. Well, I'd like to start explaining a little bit what really ProColombia is and what we do, and that will goes into how we monitor all of this and how we see blended finance as one of the key strategies to promote foreign direct investment and the economic growth that they pursue in Colombia, right? So ProColombia is the economic development agency of the government of Colombia. Our approach differs a little bit from the traditional economic development approach that we usually see in North America and Europe, where foreign direct investment attraction and business retention and tourism goes together. We put these two plus traits all together that give us a broader view and creates a lot of synergies to see how we can support companies and institutions that they're trying to get used to the country and the region, because we're seeing sometimes that Colombia is the first place where they land and they expand to the region from there. Blended finance for us is not something new. We've been seeing that happening more than 10 years ago with probably the most ambitious infrastructure program that we ever had in Colombia. It was called the 4G infrastructure program, and it was billions of dollars towards developing the infrastructure in the country, basic infrastructure. And the innovative thing that we used at the time was a blended finance approach to engagement investors. So in that case, we're seeing the blended approach where the government might take some risk and accompany companies to soften that risk in the region. We understand that sometimes numbers and returns are not the same that they can get in traditional investment regions as Europe or North America. So blended finance approach for us is quite important. On top of that, we're seeing how it's moving towards new things. And this new sectors that we're seeing, it's growing, and it still is a little bit, from our side, it's a little bit slow. We as a government would like to see this more growing and taking more risk in that sense. Agricultural, sustainable agricultural, renewable energy are very important, and we're seeing a lot of trends in blended towards when they were saying when Andrew was mentioning the finance part, we're seeing a lot of that finance, especially in financial inclusion and microcredits, and we're seeing a lot of successful financial tools that are being developed to reduce gender gaps. So this has been quite strategic for us. And as a government, as a country, we're seeing that as a tool that will help us to develop especially areas where traditional investment doesn't really have any interest.
Great. Thank you so much, Diego. Very interesting on the call for additional risk-taking from the government or the public sector, in this case, to mobilize additional resources in the region. Let me switch over to Carolina. Hi, Carolina. Thank you for being with us this morning and today. I'd like to pose the same question to you. I know you have vast experience and numerous transactions that are blended in the region. And perhaps you can comment a little bit about the activities that you have been engaged with and tie them and reflect on the data that was provided by Andrew and a resonance with the trends that he presented as well. And just your overall perspectives of where we see blended finance and how do we see blended finance in the region and overall. Thank you, Carolina.
Thank you, Heiner. Yes, of course. I think from our perspective, it's a very different blended finance perspective because we only do debt investment. And debt investment, when it comes to blended finance, brings in a lot of different actors and a lot of different players that what we saw in the presentation before. So in that sense, Viwala realized a couple of years ago that blended finance was the best structure to do loans to missing middle entrepreneurs. The reason to do so, especially focusing on women-led, LGBTQ-led, and impact entrepreneurs, was because traditional financial institutions did not see these companies as something worthy of investing in due to their structured financial and accounting practices, the fact that they don't have any collateral, have no credit history, and are assessed as too risky. So going back to why we think blended finance instruments are so important when we're doing debt investment is two-sided. On the first side, we see it is very important to make loans more accessible, especially for this type of entrepreneurs. So I think across Latin America, but specifically in the countries where we are doing our disbursements in Mexico, we see interest rates from 45 to 120% interest rate for this type of entrepreneurs who are smaller. They are more traditional businesses. They do not have the high growth, high tech business models that interest VCs. And for this reason, they need very specific debt tools. And to lower the interest rate for these investors is very, very important to have blended finance tools. We have the traditional investors coming from the private sector, but we also need the philanthropic investors, those DFIs, et cetera, to make sure that we are lowering the interest rate to something that these entrepreneurs are able to pay back, and not only pay back, but continue to grow their business and grow their impact. And I think the second one, and the second reason why blended finance is important for entrepreneurs who are in the missing middle, is the lack of collateral. So most of these entrepreneurs have no collateral, no obligados solidarios, no one to back their loans, and therefore traditional investors are very not likely to do the investment. And here's where blended finance can play a very important role. And again, I think what Diego said is very important. We need to see more risk-taking in terms of all the actors in the sector to become those who are providing the collateral for the entrepreneurs.
Thank you so much, Karina. Very interesting. Once again, highlighting the fact that additional risk-taking or more risk-taking appetite should be present in the region, and that can offer an opportunity for mobilizing additional resources, especially when considering blended finance structures. Let me turn over to Ariane. Ariane, hello. Thank you for joining us today. Ariane, I know you view and your activity is towards the region. And I pose a question to you as well. as to what are the activities or what are the opportunities and trends that you're seeing in Latin America as, let's say, an external and as an external investor. And if you can also reflect a little bit on what the perspectives are or the data presented and the trends presented by Andrew in the data brief, that would be terrific. Ariane, thank you.
Yeah, no, thank you very much for inviting me. And as I was watching the presentation and listening to the two co-panelists, one point that comes out, and thinking as an international bank, is that it's a good problem to have. But Latin America has a very, in many of the jurisdictions, most where the volume of the transactions, the capital has gone, have very well developed local financial institutions, which I think it's a good problem to have. But yes, and then the point and the question from the international institutions is, how can you meet them? Where do you meet them to work on transactions? Because the activity in blended finance from the international financing community has really been focused in large single transactions, large infrastructure transactions. So how can we actually move? And the view from MUFG in terms of blended finance is that blended finance is the tool that moves us into countries and sectors that we can't go on our own. And we're seeing that the development of the market, especially on renewable energies in Latin America, is to a developed stage in which institutions can go on their own. So our question for LATAM, as we think of blended finance, is what's next and what's the next frontier? And then we touch on pipeline, which was a great presentation from Andrew showing. And this is another inflection point, I think, interesting as some food for thought, is how pipeline is built from the private capital side. I think that traditionally banks, investment officers, debt funds, they would have their checklist of what are their wish lists, and they will hunt and look for projects and originate projects based on that. I think as we try to move forward and work in projects of new sectors such as climate adaptation, the work is backwards. It's actually finding the transactions that don't work. And then you take a Lego approach, it's a modular approach. You go and look for what doesn't work. And it's very different when we talk to other bankers. Bankers are taught to look for what works for the institution, and you go and you look for what doesn't work. And then you bring the tools that you have in blended finance, which is very modular. You can adapt and make it fit for purpose. So I think this is really what MUFG has been looking, and we're working in programmatic approaches, so platforms where we can aggregate small loans that we can't do it on a standalone basis, looking on local platforms. So how can you create program approaches locally and using catalytic capital from the own countries? So case of Colombia, Brazil have very well developed public sector entities that can actually act as the catalytic provider. So those are my 3 points that I've been writing it down since the presentation. So thank you very much.
Thank you. And very interesting indeed how the engineering or the reverse engineering can be adapted and adjusted within, let's say, a blended finance transaction in order to develop new markets and pipeline accordingly to the depthness of the markets in the specific countries, the participation of the public sector in those markets, or philanthropic sector, or catalytic capital in those markets. But overall, I think there's also an additional appetite or an additional call to have more risk taken in order to explore these potential new investments and potential new markets and potential new deals that might surface. Thank you very much, Ariana. Let me go back to you, Diego, with the following question. The foreign direct investment, the flow of foreign direct investment into the region in 2022 was about 55% higher than it was in 2021. And this is according to the United Nations Economic Commission for Latin America. In aggregate, we are talking about 225 billion US dollars approximately. From ProColombia and from the Colombian perspective, or Colombian government perspective, and in charge of promoting precisely FDI into the country and the exchange of trade and investments with other countries as well. How do you see the role of blended finance in driving the SDGs forward, not only in Colombia, but maybe also at a sub-regional Andean region level, or even regional as a whole, South America?
It's a good question, Heiner. And when you start to analyze and break down those numbers, you'll see that basically, well, first of all, that 50% increase is because we were coming from a kind of normal post-COVID situation. But also, historically, many of the foreign direct investment that's coming to Latin America always goes into extractive sector, I mean, mining and oil and gas, or commodities. That's a huge challenge. So, and if we see regionally, first goes to Brazil, Mexico, and they'll trickle down across the region. So it's not necessarily that Latin America, it's one single region. It specifically goes to sectors, those sectors that doesn't really create a lot of development, and those countries that they're big enough to receive those kind of investments. So the challenge is, what do we do to bring this kind of investors towards new kind of investments where we need it the most, right? So the beauty of government is we can take this long-term approach, and this is what we see probably 8 years ago when we envisioned the foreign investment going into the specific projects. Impact investment will be quite critical to take the development of the SDGs and how we accomplish these SDGs towards this. So there is one SDG specifically that is related with energy and the development of renewable energies, where traditional institutional investors, they feel safe about it. But what about the rest? What about bringing the investment toward communities, to social investment where we need it the most, right? This is not something that investors are very interested in or keen, because they don't really see any kind of traditional returns there. So we're seeing that impact investment by the time was having a really important approach to fulfill those gaps that we needed to get into accomplishment of several different objectives in the SDG 2030 agenda. And we had, so we decided to go towards what we have and how we have to develop the ecosystem in the country. So one of the first things was looking around to see what are the countries that they have one of the most developed ecosystems in that sense. We're seeing that the blended finance approach and adoption was huge in Canada. So we approached Canadian government. It took us many years, and I would say many ambassadors, to finally develop some sort of aid towards developing and strengthen the economic development towards impact investment. So right now, as a government, we're seeing that we need to help to put the basis for the sectors to growth. So we understand the investors needs to take more risk. So how we as a government will be able to provide more risk towards them, right? So what we're doing is, with the Canadian government, they establish a program after many years of going and trying to establish what they're doing, what is happening in Colombia, is basically the impact investment. We didn't really have a lot of impact investor funds. So partners that they're going to be able to have this partnership and be able to know what international investors are looking for. So we don't really have local partners. So we need to develop local partners. And we need to develop also pipeline, not the traditional pipeline of renewable energies that it was happening already, but those other pipeline that we need to get for international investors being able to get there. So preparing funds, preparing local funds, preparing also what we call projects in incubators and impact investment incubators to develop those projects. So creating pipeline, creating managers for these funds, being able to understand that, and also educating the government within, because we, for example, as a ProColombia, we could be a partner in the technical assistance side for any project that it's looking for to independence in finance structure. ProColombia can provide a technical assistance in that part. one of the key challenges that we see on all these projects is we receive investment in dollars. We ended up deploying that investment, and usually traditionally, and not always in other countries, but investment in dollars, it will trickle down in a local currency. The local currency is exposed to FX devaluation, right? So when we see that, we are very interested in supporting investors that they are looking to get also the return in dollars. Many of those returns might be accomplishing by exporting their goods or services from the region all over the world. In that sense, ProColombia might be a key partner for them, providing the technical assistance they need to do that. So moving from the traditional, safe, energy renewable, financial environment towards more risk takers like agricultural or production of goods also might be a good thing for us, and we're able to provide that. We're trying to encourage the participants to do that, and making sure that the government is supporting them and with providing, I would say, innovative approach toward those kind of non-traditional, I would say, blended finance structures that we can accomplish in the region.
Terrific. Thank you so much, Diego. Carolina, going back to you, Viwala issues, amongst the various activities that Viwala does, is you provide loans to women-owned businesses owned by women in Mexico and the Central American region. That is one of the initiatives that you have in the portfolio of offerings as Viwala. Can you comment a little bit, and you've already mentioned this at the beginning or during your first intervention, as to the benefits or why turning into a blended finance structure, and perhaps highlighting a little bit of the challenges that you've encountered when you were trying to find the correct vehicle or the structure, depending on which specific transaction or vehicle Viwala was setting up, and how it was tailored to the corresponding market.
Of course. So I think to answer that question, I need to explain a little bit of what Viwala does. And it's the type of vehicle we have developed is bringing international and foreign investors and then creating the correct blended finance products to deploy to the entrepreneur. So we become that agent that sees the entrepreneur's products that they need, sees the debt investment that they need, and then tries to figure out how to create that bringing from different type of investors. In order to do so, we've encountered several challenges, but the first one is how we structure our entity legally. And I think that is very important because we cannot structure ourselves as a traditional fund where we raise capital at a single point and then deploy the funding expected a return in the future. We cannot be a fintech because that would require a lot of technology advancements, and the type of companies we're working with are not necessarily those that a fintech would invest in. So we've created this merger that's very hard to explain, both hard to explain to our entrepreneurs and hard to explain to investors. So raising the correct type of capital has been an issue in order to bring in those traditional investors, bring in private capital, bring in any international organization, bring in philanthropic organizations. So creating the correct legal structure to be able to bring in those type of capital and then deploy in the blended finance vehicle has been one of the main challenges. And that also brings a little bit of what Diego was saying of FX risk. So in our sense, we raise capital in both US dollars and euros, and then we deploy only in Mexican pesos. So the question here is, who carries that FX risk? Is it the investor who is willing to give in US dollars and expect the return in whatever currency we're deploying in? Is it us as the financial vehicle in the middle who receives the US dollars, lends in Mexican pesos, and then has to return in US dollars? Or do we transfer that to the final entrepreneur? And in doing so, we raise the interest rate. So there's an entire system that we have. And again, going back to the risk taking, we need for those investors to be willing to take more risk on the FX side, to understand that the entrepreneurs are not the ones who should be taking that risk. And as the ones with the muscle, the investors should see how to better balance that and not expect a return in the currency that they are, or different hedging options and I think a little bit like with what you were saying, Diego, about agricultural sector, like seeing some type of swaps and currency swaps that would be able to help a better product at the end. And I think another challenge we're facing is we currently only deploy funding to missing middle. Missing middle tickets tend to be very small. Our average ticket size is 35K. And to do 85, 90 type of investments in a year at a 35K ticket range, we require a mix of technology to be able to be more efficient in the way we do the deployment, but we also require a bigger team. And how do we do that when our investors are expecting a 15% interest rate return while our operations are heavy? So again, it's that type of mixing and being able to bring in investors who understand our structure, who understand missing middle, who understand the type of impact we're trying to develop, and who are willing to take that risk with us, and who are willing to help those entrepreneurs who are at the end of on the receiving end to grow. So I think those would be the challenges, and those are the reasons, again, why we decided to do blended finance, because it's bringing all the actors, understanding what the investors need, but also understanding what the entrepreneur needs, and being able to be like that matchmaker for product times investor.
Very interesting. Thank you, Carolina, for sharing the overview and the multidimensional views of what the challenges were for everyone, how they turned to blended finance structures for the deployment of their deals on these transactions. Going back to you again, Ariane, Mitsubishi UFG Financial Group is one of the largest financial groups in the world. You're a regulated investor. You have certain fiduciary limits or fiduciary restrictions or fiduciary allowances. You have certain limits as to where you can operate, certain risk factor considerations that you have to include. Yet you are one of the most active organizations in blended finance transactions, according to our database, in the world and in Latin America as well. What does Mitsubishi do differently? How do you circumvent those restrictions and or limitations in order to pursue and enable new transactions or new deals in Latin America region?
No, thank you. That's a great question. And I think it goes back to the point that I've made, is that there is a behavioral element to it, of looking at something that doesn't work and finding what are your gaps, how can you fill in the gaps, and the gaps that you cannot, the gaps you cannot bridge, then have a decision if that's a risk that we are willing to take or not. But I think that that mindset of spending different of, we now get involved in projects at very early stage, different from traditional project financing, where you will get a request for proposal from your project proponent, and you see, so you go what we call at the early stage, and then that's where the modules starts to draw, that I think private banks and private institutions are starting to learn of these tools, as mentioned by Diego, technical assistance, looking at how can you design the project together with the governments or with the sponsor, so that it will meet what we need in terms of risk, regulatory risk, and that. At the same time, on the other side, with the public sector, we have to work on that model of have an active discussion with those partners, so you can understand what sorts of instruments they can deploy, and how can actually you, from the feedback of the private sector, they can move. I think that I've seen the question, and I'll answer in a minute. What we've seen is that the MDBs and the GFIs, the philanthropies, they've moved a lot in the past 5 years in terms of innovation. Picking up on the FX risk point, we, for instance, we have launched a platform for climate adaptation, where we are getting grants from the government of Canada and other philanthropies, which will bear the hedging costs. We'll be working with TCX and MFX, who are an impact hedging provider, so we can provide loans directly in local currency to the borrowers. So again, what we are doing differently is the way we look at the transactions and to structure them. Not always works. Sometimes we get to gaps that can't be bridged, and that's it's only natural. But that's what that's really the path we've been taking. And regarding the tickets, MUFG as a bank, we will look at transactions on a very large size. We'll be looking at minimum of $50 million in a single transaction. However, again, through the new approach of looking at funds, so we are launching a fund with the government of Canada, the Green Climate Fund, which is a $1.5 billion fund for climate adaptation. It has 8 jurisdictions in Latin America. The fund can deploy loans as small as 5 million because you are looking at a portfolio approach. And my final point to LATAM, and I think it's a region that has, as all continents in the global south, have middle income, almost investment grade jurisdictions, and then more vulnerable jurisdictions, is that from an investor perspective, if you can take a portfolio approach and invest in the in a fund, you can then balance your risk where you can obtain more return from a lower rated jurisdiction, but in the overall you are balancing it so that it meets the risk criteria of private investors. Thank you.
Very interesting. Thank you, Mariana. And I think you read my mind because I have a follow-up question based on your final comments. But before getting into that question, I wanted to open up the floor to our participants to see if they had any questions that they wanted to ask directly to our panelists today. Please feel free to turn on your camera, go live, or unmute yourself. You can also drop the question on our chat box if you feel more comfortable doing so. And we'll give you 5 or 10 seconds maybe to see if there are any questions at this moment, directly or via the chat box.
Ariana, it looks like you have a question for you in the
Right.
Oh, sorry, Ariana, it looks like there's a question for you in the chat.
Yes. So the one, as I mentioned, in terms of the tickets, MUFG, as a banker, we look at transactions usually of $50 million or more. But through the platform work that we're developing, such as the case of the Gaia Fund, we then can look at transactions as small as 5 million. In terms of sectors, we work in blended finance, and we focus both on the environmental but also on social. In social, we've been very active in the terms of social infrastructure, education, healthcare, through public financing. And as part of my team, the drive into climate finance has been now focusing in moving the bank. I think the 2 main focus areas of our in climate, it's been climate adaptation. How do we move the private sector into climate adaptation, and energy transition as well?
Great, thank you. Sneha, any more questions from our chat box that we can? Okay, while we wait for those questions to come in, I had, and going back to your final point, Ariane, in the last intervention, we tend to see Latin America and the Caribbean as a single unit, as just a single geography or a single country with just one jurisdiction, one language, one culture. But in reality, it's very diverse and very dispersed. Diverse in the sense of the rich cultural background that we have, dispersed in the fact that we have different depths as far as the local capital markets, as far as the maturity of the policies and institutions and the regulatory bodies that we have within those countries, the opportunities for new deals as far as who the counterparts might be for investments. So we really cannot think about Latin America, and we should not think about Latin America and the Caribbean as just one single unit, but more as a very diverse and very rich and very attractive with a high potential for investment region. I know, Ariana, you've alluded to this at the very end of your intervention, but how can we work towards mobilizing additional projects, perhaps at a sub-regional or regional level in Latin America. Curious to know that from all our panelists this morning. So please feel free after Ariane, Diego, or Carolina to just jump in to see what your views would be as taking Latin America for what it is, in the sense that it's one united continent, if you will, but it is also dispersed and individually attractive on a country specific basis. Ariane?
No, thank you. And I'll take the example of what we've been doing in the climate adaptation space, where we're working with 8 jurisdictions in Latin American Caribbean, and we're going from Paraguay to Jamaica. And I did the trip where I visited all the countries, the 9 countries from Paraguay to Jamaica, and it's a very distant realities and market practices. But at the same time, you can create exactly what you're saying. We took a regional view where we can adapt the final loans to the realities of the countries that what they need. So in the case, let's take the case of Peru, where with Proinversión and the PPP framework, where you can have financing for specific projects. You don't need to have financing done via the sovereign. You have well enabling environment for PPPs financing, or where you go into countries where the financing will be centralized and you have to work through the central government. So based on our experience, what we've seen is find a common denominator between the countries that you want to aggregate. If it's sector, if it's the type of investment that you're working, but find something that you can use as your common denominator. And then from that, you can work out what are the adjustments that you have to make for the realities of each of the countries, because you can't come up with a one size fits all, because what works for Colombia will not work for Brazil or not work for Dominican Republic. So this is the work that we've been building out of. We start from a framework, a catch-all framework, and then you work on the adjustments of each of the countries. In the case of our fund, what we have is we have a business plan for each of the countries that we are working on, so that we are mapped in what are restrictions, requirements, priorities for each of those countries. This is really the path we've taken to be able to work with multiple jurisdictions under one single umbrella.
Thank you, Ariane. Diego, Carolina, care to comment a little bit about the dispersity and the unifying factors of the region?
Yeah, I'm happy to jump in from a different perspective, and it's more from the design of the vehicle. So basically, our approach has been to design a vehicle that's flexible enough to be able to go across the different regions, different sectors, and we do so by impact theme. So we do like a product for Colombia, a product from Peru, but we do a product for women-led, a product for LGBT inclusion, a project for opportunity youth. And even though the differences across the countries might be huge, there is the same like core social or environmental program. And we designed the product saying we need X% to be philanthropic funding, we need X% to be private capital, we need X%. And then when we come to the country, we find that philanthropic funder that's working in the country, and we find that like government that's working there, but it's the product has already been designed and can be applicable across all the countries. So it's designing flexible vehicles that address a specific impact theme more than anything.
Very interesting. Thank you. Diego, any comments?
Yeah, actually, there's so many interesting things popping up in my head after all these interventions of Ariane and Carolina. I think the portfolio approach is very smart. Definitely, one of the challenges that we struggle with is, and it's still when Ariane mentioned the fact that their minimum ticket is 5 million is still a lot of money for all of us. So there is a huge gap between what the traditional financial institutions all over the world consider as a minimum investment ticket and what it really the Latin American as a whole region will be able to provide. Traditional $50 million tickets, I would say that is even difficult to find even in countries as big as Colombia. I would say only Brazil and Mexico will be able to provide this kind of pipeline for these institutions. So the challenge that we see is how do you be able to, and we understand as a government that the cost and the administrative cost of small transactions are exactly the same as larger transactions, and we understand why those institutions always go towards bigger transactions. But there is a permanent mismatch between this and the reality in the country, so or the region. So a portfolio approach will be very smart to do. I would say local partners is especially important because those local partners, they might be able to have the knowledge to spread all over the region, and they will be able to provide this portfolio approach that these traditional investors or let's say blended finance investors in all over other geographies are looking for, and they can provide that, I would say, volume of transactions that they need. Also understanding that, well, we go back even that saying as a government, okay, we face sometimes that there is a lot of people all over the world that they don't really have and they don't really understand Latin America. So what we do, so you can find institutions like ours all over Latin America, a government economic development institutions that we're able to provide a mix of services. We have tailor-made, custom-made services to investors that they don't have any experience and never been in the region. And we have this kind of a concierge service, one-stop shop approach for those companies. We take them by the hand and we introduce them to potential partners until they're satisfied that they can find that partner, right? So there's very different levels where they can approach the region. And I would say one last one is, even if we see as a whole region Latin America, there is small integrations between countries. The CARICOM, the Andean Pact, the Mercosur, those regional integrations provide also a fixed set of rules and regulations that will facilitate that if you, for example, set up your headquarters or your partner is in Colombia. Well, Colombia is a member of the Andean Pact, is member of the ALADI, has some agreements with the Mercosur that will facilitate to spread the investment all over those other countries through a standardized set of rules of customs, tariffs, or even the payment systems that it's already standardized with all of this integration. So consider that not Latin America as a region, but seeing this small integration that it still makes quite interesting the size of those integrated countries, and that will be a starting point for you.
Very interesting. Thank you, Diego. And very interesting call for the SDG 17, which is precisely strategic partnerships or partnerships are essential in order to move and towards the SDGs. And blended finance structures, in a certain way, by definition, address SDG 17 because of the way that different parties and different participants and different stakeholders participate within a structure. I know we're running out of time. Let me run it by Sneha to see if we have any additional questions that are coming in the chat box. Please go ahead.
Yes, we have a couple of questions related to the Caribbean. If the panel could speak to blended finance in that region and any projects or pipeline they're familiar with, any perspectives, that would be amazing.
Yeah, just if I could pick on the question about, and it's a question, I'm just getting the person here, about the bankable pipeline projects, considering the size. I will use the example of a live exercise. We're working with the government of St. Lucia. They've just released their Blue Bond framework at COP, which we've been supporting. And the idea there is exactly starting from the framework where it sets what are the priorities of the countries aligned with their NAPs. Again, the modular approach where GGGI help them as a technical supporting to the capacity building for the development of the framework. And then based on that, you can then have the actual financial instruments being deployed. And those can be of smaller size or larger. So under the framework, you can work with small loans such as 20, 15, 20 millions, or larger projects that St. Lucia might undertake in the blue economy as water access, sanitation, that could be up to 100 million. So those are the examples that we're seeing. Thematic issuances are a big thing. The most of the debt for nature swaps that have come from there, although those are what I classify as the large one-offs. Those are transactions that are quite heavy to structure and develop. So to achieve the scale that we need in smaller jurisdictions, we see the scale coming through replication of smaller projects rather than just from the one-off transactions. The pipeline is there. The point, and then picking back on the question that someone else asked about dealing with the regional DFIs, I think that's the key. It's about dealing with the local players. How can you use them as the intermediary, the aggregator of those smaller projects is the key to unlock the international private sector all the way to the beneficiaries in a way that is impactful and fit for purpose. Thank you.
Thank you, Ariane. Diego or Carolina, any comments on the Caribbean specifically?
I mean, we don't deploy funding in the Caribbean, but we do in like Central America, that I believe is still larger than the Caribbean, but it's more or less the same that Ariane did. Like, we have seen very large projects. We have seen projects that have a lot of potential, even though they're coming from smaller countries. So we do see the potential, but there's also the additional risk-taking factors, especially now that we're dealing with climate change, et cetera. So it's just taking that into account when analyzing the companies in those regions.
Got it. Thank you so much. We are coming at the top of the hour, running out of time on this, our first session of Blended Finance in Latin America. I wanted to thank everyone today for their participation. That has been a very enriching and enlightening experience. I don't dare summarize all the valuable comments, insights, and information provided in this webinar. I would not do it justice. If there are any additional questions, please let us know, and we will channel those questions onto our panelists today and/or bridge and make the contact so that you can be in touch with them directly. Thank you once again for participating, Ariane, Carolina, Diego. Muito obrigado, muchas gracias. From my part, have a great rest of the day. Have a great holiday season. Felices fiestas. And I will pass it on to my colleague Snea for the final words, and thank everyone once again for being here with us this morning.
Thank you all for joining. Just a final announcement from our end. We are delighted to share that sometime, I believe next week, the 2023 State of Blended Finance report will be published in Portuguese through a fruitful collaboration with our longtime partner Dynamo, as well as Tocini Fere. We look forward to sharing the publication with all of you. So please do look forward to that and to all of the work that we have planned ahead of us in 2024 for this region. So thank you all. We will keep you posted, and all the best.